September 15th, 2008. Lehman Brothers, one of the most powerful investment banks in the world, files for bankruptcy. 158 years of history, gone in a single morning. The stock market falls off a cliff. Banks stop lending to each other. Credit freezes. Companies can't make payroll. Ordinary people watch their retirement accounts lose half their value in weeks. Within months, 8 million Americans lose their jobs. Millions lose their homes. The global economy contracts for the first time since World War II. It was the worst financial crisis since the Great Depression, and almost nobody saw it coming. Almost. Today, we're going to do two things. First, we're going to break down exactly what happened in 2008. Not the newspaper version, the real version. How it started, how it spread, why nobody stopped it, and who paid the price. And second, we're going to look at right now, at 2026, at the warning signs that serious economists are watching, at the parallels that are starting to make some very smart people very nervous. By the end of this video, you'll understand both crises better than most people with finance degrees, and you'll know what to watch for and what to do if history decides to rhyme. Let's go back to the beginning, 2001. The dot-com bubble has just burst. Trillions of dollars in stock market value have evaporated. The economy is in recession. Then, September 11th happens. The shock to consumer confidence is enormous. The Federal Reserve responds by cutting interest rates aggressively. By 2003, the federal funds rate is at 1%, the lowest it had been in 45 years. Cheap money floods the economy, and it has to go somewhere. It went into houses. When interest rates are low, mortgages are cheap. When mortgages are cheap, more people can afford to buy homes. When more people buy homes, prices go up. When prices go up, people get excited. When people get excited, they buy more homes. Prices go up more. This is a bubble forming. And in 2003, 4, 5, 6, it was forming fast. But here's where the story gets complicated. Because it wasn't just regular people buying homes they could afford. The financial system had created something far more dangerous. Let's talk about mortgages and what Wall Street did to them. Traditionally, when you got a mortgage, here's how it worked. You went to your local bank. The bank checked your income, your credit, your ability to repay. If everything looked good, they gave you the loan. And then they held that loan on their books for 30 years. If you defaulted, it was their problem. They had every incentive to make sure you could actually pay. In the early 2000s, this system changed completely. Banks started selling their mortgages to Wall Street. Investment banks would buy thousands of mortgages, bundle them together into a new financial product. And the beauty of it is, once you grab these pieces of the housing market, the original bank no longer holds the mortgage. It's all yours. Around the world. Pension funds, insurance companies, German banks, everyone wanted a piece of the American housing market. This created a catastrophic problem. The bank that made your mortgage no longer held it. They had already sold it. They had already made their money. If you defaulted, it was someone else's problem. Someone in Frankfurt, someone in Tokyo, someone in London. So the bank's incentive changed completely. Instead of being careful about who they lent to, they just needed to make as many loans as possible. More loans meant more mortgages to sell. More mortgages to sell meant more fees. More fees meant more profit. So they started giving mortgages to people who had no business getting them. No income verification, no down payment. Adjustable rates that started low and would reset to unaffordable levels in 3 years. Loans given to people who couldn't even explain the terms of what they were signing. Bavaba. These were called subprime mortgages, and by 2006, they made up 20% of all new mortgages in America. But it gets worse, because Wall Street wasn't done. Bavaba. The mortgage-backed securities got repackaged, sliced, and diced, combined with other securities. Layers of complexity added on top of layers of complexity, until nobody, not even the people selling them, fully understood what was inside. Bavaba. These new products got names. CDOs, collateralized debt obligations, CDOs squared, synthetic CDOs that didn't even contain real mortgages, just bets on whether mortgages would default. Bavaba. And the ratings agencies, the companies whose entire job was to tell investors how risky these products were, gave many of them their highest rating, AAA, as safe as US government bonds. Why? Because the ratings agencies were paid by the banks that created the products, the same banks whose products they were rating. If you gave a low rating, you lost the business. So ratings kept coming back AAA. By 2006, the entire global financial system was built on a foundation of mortgages given to people who couldn't afford them, packaged into products so complex nobody understood them, rated as safe by companies with a massive conflict of interest, and sold to institutions around the world that had no idea what they were buying. It was a house of cards, 40 stories tall. All it needed was a breeze. The breeze came in 2006 when housing prices stopped going up. When housing prices are rising, even bad mortgages look fine. If you can't make your payment, you sell the house for more than you paid. Problem solved. When housing prices stop rising, the music stops. Adjustable rate mortgages reset to higher payments. Borrowers who were counting on selling can't sell. Defaults begin. Let's, slowly at first, then faster, then all at once. Let's. By mid-2007, major financial institutions started reporting enormous losses on their mortgage investments. Bear Stearns, one of the largest investment banks on Wall Street, had 2 hedge funds that collapsed completely. The losses were in the billions. Let's. Still, the official position was that this was contained. A blip, nothing to worry about. Let's. It was not contained. Let's. The problem was that nobody knew where the toxic mortgages were. They had been sliced and repackaged so many times that they were hidden inside financial products held by institutions all over the world. When Bear Stearns reported losses, every other bank started wondering what was hiding in their own portfolios and in their counterparties' portfolios. Let's. Trust collapsed. Let's. Banks stopped lending to each other, not because they didn't have money, but because they didn't know if the bank across the table was hiding catastrophic losses. The interbank lending market, the daily plumbing of the financial system, froze. In March 2008, Bear Stearns collapsed. The Fed arranged an emergency sale to JP Morgan Chase for $2 a share, a company that had been worth $170 a share just 12 months earlier. In September 2008, Lehman Brothers. The government decided not to bail out Lehman. They let it fail. The intention was to send a message. Bad decisions have consequences. What happened instead was a global panic. Every financial institution in the world that had any connection to Lehman, any trades, any loans, any derivatives, suddenly had a hole in their books. And because of the web of interconnections that had been built up over years, that meant almost everyone. The global financial system came within days, possibly hours, of a complete collapse. Not a recession, not a bear market. A complete seizure of the global economy. The government reversed course. TARP, $700 billion in bailouts. The Fed slashed rates to zero and began quantitative easing, creating trillions of dollars to stabilize the financial system. Fannie Mae and Freddie Mac, the 2 institutions that backed most American mortgages, were taken over by the government. The immediate crisis was contained. The damage was not. 8 million jobs lost. $5 trillion in household wealth destroyed, millions of homes foreclosed. The unemployment rate hit 10%. It took 7 years for the stock market to fully recover. Some communities never recovered at all. And who went to jail? One person, one mid-level trader at a smaller bank, the executives who built the system. The ratings agency analysts who stamped AAA on toxic garbage. The mortgage brokers who put people into loans they couldn't afford. Almost none of them faced criminal consequences. Many of the banks that caused the crisis received hundreds of billions in government bailouts. Some of them paid large fines without admitting wrongdoing and went back to business. The ordinary people who had bought homes they were told they could afford lost everything. This is important context for what comes next, because the anger from 2008, the feeling that the system protects the powerful at the expense of everyone else, never fully went away. It's still there, and it's part of why the warning signs of 2026 feel so politically charged. Now, let's talk about right now. 2026. On the surface, the economy looks fine. Growth is positive, unemployment is relatively low.
We
the
see
stock
escalating
market,
risks,
while volatile,
unsustainable
is
debt,
still
excessive
near
leverage.
historical highs. Many of them before, but underneath the surface, serious economists are watching several warning signs that echo what was happening in 2005 and 2006. Not identical, but uncomfortably similar. Warning sign 1. Debt. Everywhere. In 2008, the crisis was triggered by too much private debt, household mortgage debt that people couldn't repay. In 2026, the debt problem is bigger, and it's everywhere. U.S. household debt has hit record levels. Credit card debt is at an all-time high, with the average American carrying over $6,000 in credit card balances at interest rates above 20%. Auto loan delinquencies are rising. Student loan debt sits at over $1.7 trillion. U.S. government debt has surpassed $36 trillion, roughly 100% of GDP. Annual interest payments on this debt have tripled since 2021 to over $1 trillion per year. That is more than the entire defense budget, paid just in interest. As Brookings noted, if current tax and spending policies continue, the debt-to-GDP ratio could hit 240% within 3 decades. That is not a sustainable path. Warning sign 2, the AI bubble. In 2008, the bubble was in housing. Values kept going up because everyone assumed they would keep going up. In 2026, serious economists are pointing at artificial intelligence valuations with the same concern. AI stocks now account for roughly 1/3 of the S&P 500 by market capitalization. Investments in AI technology made up more than 90% of GDP growth in the first half of 2025. The valuations of major AI companies have reached levels not seen since the dot-com bubble, price-to-earnings ratios that assume decades of perfect growth. Any disappointment, any sign that the AI revolution is slower or less profitable than expected could trigger a correction that echoes 2008 in its speed and severity. As U.S. News reported, a collapse in AI valuations could trigger what economists call a reverse wealth effect. When people feel rich because their stocks are up, they spend more. When those stocks suddenly fall, spending collapses, jobs disappear. The cycle feeds on itself. Warning sign 3. The consumer breaking point. In 2008, the crisis started when homeowners couldn't make their mortgage payments. In 2026, certified financial planner David Schneider has warned of a consumer breaking point. Households exhausted by years of high inflation and record debt that are starting to hit a financial wall. Consumer sentiment has been deeply negative for years. The cumulative effect of post-pandemic inflation, grocery prices up 30%, housing costs at record highs, insurance premiums skyrocketing, has drained the financial cushion of tens of millions of American households. When consumers can no longer spend, businesses contract, jobs disappear, the self-reinforcing cycle of a recession begins. Warning sign 4, tariffs and trade uncertainty. This one has no direct parallel in 2008, but it's arguably the most immediate risk in 2026. The Trump administration's sweeping tariff regime has introduced enormous uncertainty into the global trading system. Tariffs are essentially taxes on imports, and as Stanford economists have noted, pass-through to consumers now exceeds 50%. The Goldman Sachs projection is that current tariffs will raise inflation by an additional 1% in the first half of 2026. Inflation plus slowing growth is called stagflation, and stagflation is one of the most difficult economic conditions to manage. The Fed's main tool for fighting inflation is raising interest rates, but raising rates slows growth further. There is no clean solution. Warning sign 5, the shadow banking system. After 2008, regulators passed new rules, Dodd-Frank, designed to make banks safer, and in many ways, they succeeded. The major banks are better capitalized today than they were in 2007. But as Capital Economics has noted, if trouble is coming, it is more likely to emerge from the shadowy parts of the system. Private credit markets, hedge funds, non-bank financial institutions that have grown enormously since 2008, but face far less regulation than traditional banks. The private credit market has grown from less than $500 billion in 2010 to over $1.5 trillion today. Much of this lending is to companies with significant debt loads, exactly the kind of borrowers who struggle when economic conditions deteriorate. When these loans go bad, and some will, the question is how interconnected the losses are. 2008 taught us that in a complex financial system, losses in one corner can destroy the entire structure. The shadow banking system of 2026 is enormous, opaque, and largely untested under real stress. So is 2026 going to be 2008? The honest answer is probably not. Not exactly. Most mainstream economists are not forecasting a 2008-style collapse. The IMF projects global growth of around 2.5% in 2026. U.S. GDP growth is projected at 2.3%. The banking system is better capitalized. Regulatory frameworks are more robust. But here's what 2007 taught us about economic forecasts. In June 2007, 3 months before Bear Stearns collapsed, Federal Reserve Chairman Ben Bernanke told Congress that problems in the subprime mortgage market were, and I'm paraphrasing, likely to be contained. In July 2007, he said the losses from subprime were likely to be in the tens of billions, an amount the financial system could easily absorb. The actual losses were in the trillions. Not because Bernanke was incompetent, but because the complexity of the system made it genuinely impossible to see the full picture until it was too late. The same complexity exists today. The same incentives to minimize risk exist today. The same human tendency to assume that what has been working will continue to work exists today. A financial crisis is not inevitable in 2026, but the conditions that produce financial crises, excessive debt, asset bubbles, complex interconnected financial instruments, overextended consumers, policy uncertainty, are present in ways that should not be dismissed. 2026 is not a year that screams crisis, but as financial analysts have noted, it is a year that can no longer guarantee stability. So what does this mean for you? Not panic. The lesson of 2008 is not that you should put your money under your mattress and wait for the apocalypse. People who did that lost enormously to inflation while the market eventually recovered. The lesson is about preparation, resilience, not being the person who is forced to sell at the worst possible time. Step 1. Emergency fund first. In 2008, the people who were most devastated were those who had no financial cushion, who had to sell their investments at the bottom to pay their bills, or who lost their jobs and had no savings to bridge the gap. 3 to 6 months of expenses in a high-yield savings account is not just financial advice. In a crisis, it is the difference between weathering the storm and losing everything. Step 2. Reduce high-interest debt aggressively. Consumer debt at 20% interest is a ticking clock in good times. In a recession, when income might drop, it becomes a crisis accelerant. Pay down credit card debt before investing in anything else. The guaranteed 20% return from eliminating that debt beats almost any investment. Step 3. Don't try to time the market. The people who sold everything in October 2008 locked in their losses. The people who held, or better, kept buying, recovered everything and then some within a few years. Nobody consistently calls the top or the bottom. The strategy that works is the boring one. Keep investing regularly. Don't panic sell. Step 4. Diversify. The 2008 crisis hurt most the people who were concentrated in one thing: housing, financial stocks, their company's own stock in their retirement account. Diversification across asset classes, stocks, bonds, some real estate, some international exposure, reduces the impact of any single sector collapsing. Step 5. Understand what you own. One of the defining features of 2008 was that almost nobody, including professional investors, understood what was in the financial products they owned. CDOs full of toxic mortgages, rated AAA by paid-off rating agencies. If you own something you don't understand, find out what it is. Index funds and ETFs are transparent. Individual stocks are knowable. Complex structured products are dangerous precisely because of their complexity. Let's bring it all together. Dr. 2008 was not an accident. It was the predictable result of a system where incentives had become completely disconnected from consequences, where the people making risky decisions faced no downside, where complexity was used to obscure risk rather than manage it, where the official assurances of safety were worth less than the paper they were printed on. Dr. 2026 is not 2008. The specific triggers are different, the regulatory environment is better, the immediate risks are different in their details, but the underlying dynamics, too much debt, inflated asset values, systemic complexity, overextended consumers,
The human tendency to assume good times will continue? These are the same. Doctor, history doesn't repeat, but it rhymes. Doctor.
The question is not whether you can predict the next crisis. Nobody can. The question is whether you are positioned to survive it and even benefit from it when it comes. Because it will come. It always does. The only unknown is when. Understand the system. Build resilience. Don't panic. Stay invested. And remember that every crisis in history, including 2008, eventually ended, and the people who were prepared came out the other side stronger. If this video helped you understand what happened in 2008 and why 2026 deserves serious attention, hit the like button. It genuinely helps more people find this content. Subscribe, because next week we're finally doing the Roth IRA, the account that lets your money grow completely tax-free. Why it might be the single best financial tool available to